Okay, Lisa, we're live. Welcome everybody to Wall Street Reporter's next Super Stock live stream, February 16th, 2021. We have a debut presentation today from Relic Health Technologies, RHT, on the TSX Venture Exchange. For anybody that's new to our program, our goal with these live streams is to bring you those stocks which have that 10x to 100x upside potential. So these are companies which have three things in common. They're going after multi-billion-dollar market opportunities, so massive market opportunities. They're at a key inflection point right now with massive growth to come, and they have multiple catalysts in place. Those of you who've been following our program have already seen we've had a bunch of 10 baggers in the last, or 20 baggers even in the last 18 months. The most recent one, of course, is CBDT, which just in the last 4 months is up. I think it's like 1,700% as of today, from a nickel to 80 cents or something like that. So today we're going to find out if Relic is going to be that next 10 bagger. The stock is 88 cents. Very auspicious number in a Chinese New Year right now. So this is a good number. So our audience wants to know what's going to be the path. Can this be an $8.88 stock? So with that said, Lisa, we're gonna start. I'm gonna ask you a couple of questions, but the main thing is, for those of you watching, please ask your questions, because it's your questions that really are key to this, and then decide for yourself if a Relic is going to be our next 10 bagger. So with that said, Lisa, welcome to the program.
Thank you for having me, Jack. Very excited.
I know we got a lot of fans here. A lot of people very interested in knowing what you're doing here with the stock. So, Lisa, for anybody that's new, again, in a snapshot, what does Relic do in the health tech space?
Right, so we're a digital healthcare company, and essentially we provide virtual care to patients, typically with chronic diseases, but chronic disease includes things like managing mental health conditions. We sell to healthcare organizations, so physician practices, home health agencies, skilled nursing facilities. They are reimbursed by private insurance and Medicare and Medicaid, and those organizations have continued over the last 3 years to dramatically expand reimbursement around our services. So essentially, if you have a patient who's got, let's say, congestive heart failure, and they're at home, we know that in the developed nations, less than 20%, or rather around 20% of all of the population have chronic diseases, but they account for 70 to 80% of all of our healthcare spending, because those patients are responsible for managing their own conditions in the home on a day-to-day basis, and they don't tend to do a great job. Less than 50% of them take their medication as prescribed. So little interventions in the home can have a big impact on that population. And what we do, we have a cloud-based SaaS software, and we connect to patients' devices. So if you have congestive heart failure, you'd have a scale in your home, maybe a blood pressure cuff. If you also have diabetes, you have a glucose meter. And we collect the data from those devices and immediately upload it to our cloud, where we deliver alerts, automated alerts to your clinical care team if you're starting to destabilize. So something like a 2-pound weight gain in a congestive heart failure patient in 24 hours indicates they're going into heart failure. And if their clinician calls in a prescription for a new diuretic, maybe change their cardiac meds, they can keep that patient healthy and at home indefinitely. But if you wait until the patient starts to experience physical symptoms like chest pain or pressure or difficulty breathing, then that patient's looking at an ICU stay in the hospital. And that costs the healthcare system hundreds of thousands of dollars. So little interventions like we enable with our proprietary technology have a dramatic impact, not just on patient health outcomes and quality of life, but certainly on healthcare spending. Excuse me.
So essentially, what you're able to do is you're able to offer, the insurance companies, et cetera, really kind of like a no-brainer solution that, they're going to, pay. What's the cost of your, so in other words, they're going to get a positive ROI right away. So in other words, the cost of your service is how much per month? It's a SaaS, so it's how much per month?
Yes, so we charge an average of $40 US per patient per month, but the clinicians who use our services receive an average of $315 per patient per month from Medicare and Medicaid, and if they use our services. So that's a brand new revenue stream for them, and it's almost pure profit. So there's a very compelling market pull for our technology right now, with in healthcare. When we started in sort of late 2017, 2018 with patients, and there were billing codes in a few states under Medicaid. And in January 2018, Medicare, the federal program, introduced one billing code for remote patient monitoring. And clinicians could make approximately $59 per patient per month by using our platform. 59 back in 2018. Since then, they've introduced.
Can you explain for anybody that might not know the billing code? What does that mean? Like,
right. So what it means is that Medicare and Medicaid have said, we want patients to receive this virtual care. We know it keeps them out of the hospital. We've demonstrated with clinical data that this keeps patients healthier and therefore they cost the system less. So we're going to provide this service through physicians or home health or skilled nursing facilities, and Medicare and Medicaid are going to pay for it. But when they started paying for it in 2018, it was you could only make as a physician or home health around $60 per patient per month. They've since, over the last 3 years, increased the number of billing codes available from 1 to roughly a dozen. So the number of possible services that are covered that use our technology, and they've increased the size of that reimbursement from $60 to $315. So an average physician practice can bring in a new revenue stream of between $500,000 and $1 million a year just by deploying our platform.
Okay, so this is a key point.
Yeah.
So let's say a doctor so basically, a doctor has a bunch of patients. He's getting another 500 grand, $1 million right to the bottom line.
Yeah, exactly, because Medicare and Medicaid have recognized that the average cost of care for a chronic disease patient, because they end up in the ER, because they end up in the ICU, is anywhere from $25,000 to $250,000 a year. But if you use our platform, so you provide that more proactive care, you can bring the cost of care for that patient down to $2,000 to $4,000, depending on what medications they need. So it's a huge cost savings, and it's ultimately going to enable Medicare and Medicaid to devote $50 to $100 to $200 billion to this upfront proactive care, but save $1 trillion on the other end.
Okay, so basically there's kind of a I like these things where there's a no-brainer argument for deploying the solution, so that makes things easy. There's already an incentive. There's a significant financial incentive for the doctors to recommend their patients use this, and also the insurance companies. They have, they see this, clearly as a major cost savings. And one thing stuck out. So in terms of how big is the market opportunity, you just mentioned a couple numbers. So what's the size of the market opportunity really that you're addressing?
Right.
Relic, what are the total markets that you're addressing like right now?
Yeah, our total addressable market is over 100 billion US. We are targeting primarily the 37 million Medicare and Medicaid patients who have 2 or more chronic diseases. But as we move forward, we're getting more and more interest from the private insurers who have a similar patient population, if not larger. So it's an absolutely massive patient population and a very large market that's only expected to grow as the population grows and ages.
Okay, and now how does the technology work? Because I know there are various companies doing different things in this sector. Everybody sees the same opportunity that you're looking at. What do you do differently?
Yeah, so we built our platform specifically for the community markets. If you look at healthcare has traditionally had the bulk of the budget from insurers, whether private or government funded, was aimed at the acute care space, so hospitals. The community care space is everything outside of the hospital. And so the way we save money in the acute care space, we close small rural hospitals, we close or reduce the number of beds in large hospitals, we reduce the length of stay for patients. So, if you have a mastectomy, you might be out in 3 days instead of staying for a week or 2 weeks. But that's really just rearranging the deck chairs on the Titanic, because only 20% of the budget that's in acute care is really going to be affected by those kinds of changes. Whereas the 80% of healthcare spending that's going to chronic disease patients, the reason that they're so expensive is because they have a lot of preventable complications. And the way you prevent those complications that lead to these really costly ICU stays is by encouraging them and providing some accountability, some engagement, so that they are checking their vital signs every day, they are taking their medication, and you get an alert if they're not. And that really seems to get them involved in a more proactive way in their care. And so the way that other companies in the space like Vivify, as an example, or Philips, or even TELUS, have engaged with the healthcare system traditionally on virtual care has been aimed at hospitals. So integrating with hospitals' electronic medical record systems, taking their patients post-discharge for that 30-day window during which there are potential penalties for readmissions. But those systems are very complex. They're what we call very heavyweight. So they require a hospital IT team, which would have dozens to hundreds of developers, to both support the implementation and deployment, but also ongoing support and maintenance. So they're millions of dollars up front, millions of dollars a year. And that won't work in the community, because in the community, the skilled nursing facility, the home health agency, the physician practice, they don't have an IT department at all. So they can't manage a really heavyweight layer. What they need is something that lives in the cloud, so they don't have to have their own server farms, that's incredibly intuitive and that really matches that community-based workflow. And we built that from the ground up, and what we have in the market's very unique in that respect. It's very, very quick and easy to train people to get it up and running. If you sign a contract this morning, we can have you up and running by tomorrow, fully trained. So it's a very intuitive interface. But we're looking at the patients that we're serving. You know, I think that's where there's some key differentiators. So most of the chronic disease patient population, our average patient age is 75. So they're elderly. They're coping with multiple very significant chronic diseases like congestive heart failure or chronic obstructive pulmonary disease. So if you give them an app on a tablet or on their phone or a computer interface, these are not patients who are tech savvy. They may have visual acuity issues, and they're not keen on learning new technologies. So you have to be able to meet them where they are. So while we do have apps and web interfaces and very, slick UI in that perspective, from that perspective, we don't require that our patients use that. So for patients, particularly in rural and remote and low income communities, we provide them with devices that will monitor their blood pressure, their weight, their blood glucose, whatever is relevant, that are actually have a little SIM card installed. The devices themselves will remind the patient in the language of their choice to take their vital signs during the day. And then using that SIM card over the cellular network, we collect the data directly from the devices. So the patient doesn't have to manually enter any data. They don't have to log on to a system. They don't have to have a smartphone, and most of them do not. And most of what's been developed in the community was either aimed at these hospitals with very complex IT systems who could cope with that, or there's a lot of little kind of mom and pop shops that do remote monitoring or telemedicine, or behavioral health integration or chronic care management. And those systems tend to either have been designed by developers who are in their 20s and have no understanding of what it's like to be a senior citizen, and they're therefore not usable, or they've been developed by physicians who are great at the workflow piece but terrible at the technology piece. And the other sort of landscape or point in the landscape would be companies like Abbott or Baxter that have hardware, so glucose meter, and they have an app that allows the patient to collect data from that glucose meter and possibly share it with their clinician. But what we consistently hear from clinicians, and this was true, running my previous company as well in healthcare, is they don't want to log on to different systems to see their patient's blood sugar or blood pressure or cardiac data. They want all of it in one system, and that system has to be extremely usable. And so we have, unlike any other company in the space, we have an extremely comprehensive suite. We have telemedicine, chronic care management, remote patient monitoring, behavioral health integration, transitional care management, principal care management. So wherever you are in that patient circle of care, we have a product that will allow you to monitor the patient and to be reimbursed for that. And it's very, very easy to use, particularly for those sick elderly patients.
So, Lisa, what kind of traction do you have? I know you had a news announcement today with this California deal. I guess it's a community. It was California. It's a California Care Management Network. So can you?
Yeah.
What is this deal about?
Yeah, so it's essentially a managed care organization. So they are working with a very large patient population across California. They're the first mover in sort of healthcare offerings specific to the Asian American community, and there's a very large Asian American community in California. And California, of course, is the largest state by population. So, having a presence throughout that state with this new contract where they have 50 clinics and over 500 physicians, that's a huge step forward for Relic, and certainly will open more doors for us on the West Coast.
You said that they have how many clinics they have?
They have 50 clinics, 50.
Okay, 50 clinics. So, if I use the numbers that you mentioned earlier, this is potentially for them, 50 million in revenues to their bottom line. And to your bottom line, what kind of revenues could this deal mean?
Yeah, I mean, we
This
haven't
deal alone, basically.
Yeah, we haven't specifically disclosed that, and this probably isn't a form of permitted disclosure. But what I will say is, with those large patient numbers, an average physician practice has approximately 3,000 patients per physician. Of that 3,000, approximately 20% or 600 will be chronic disease patients, and so those would be the patients who would be onboarded onto our platform, as well as any patients they have who are elderly and relatively healthy but are aging in place and would use the You Go Home platform. So the bottom line is this is a massive contract for us that has enormous revenue potential. When we go live with this client, which we'll do next month, we'll be able to issue a follow-up press release with more details and more quantitative metrics, and also more information on the actual network itself. But this initial announcement is relatively general, and we're probably going to have to stick with that. But
somebody's going to have to replay this and do all the math and run back through the numbers. Okay, so basically, if I'm just doing so, you get roughly how many potentially, just for anybody that is not good at math like myself, potentially how many patients do they have in their pool who could be, using your service?
I mean, certainly they have over several 100,000 patients and a significant
prospects.
Sorry?
There are several 100,000 patients that are potential prospects for your telehealth service.
They would have, well, probably more than several 100,000 patients, but the patient prospects for us would certainly be in the, what would you call that, 6-digit range.
Okay. Okay, so substantial numbers. Okay, what other kind of traction, Alec, how many of these, what other kind of traction do you have in the market, and are things accelerating? Give us maybe kind of a history of how things have been progressing.
Yeah, I mean, when we started working with patients in 2017, 2018, we were just in South Texas, and all of the billing codes, all two of the billing codes, one through Medicare and one through Medicaid, were new. And there was a lot of, kind of chaos and confusion that first year. That's not atypical with the new billing code with Medicare and Medicaid, that they'll put out a new billing code, and then when claims start flooding in, they'll kind of panic a little about how much that's going to cost out of their budget, and they end up not allowing a lot of those claims. So that was definitely a chaotic year for anyone in that space. But since then, the reimbursement codes have increased. Medicare and Medicaid have been able to document for themselves over the last 2 to 3 years that there are significant cost savings and improvements in clinical outcomes by using remote monitoring and other virtual technologies. And so we have continued to expand beyond South Texas. That was a logical starting point for us because in healthcare, it's a very conservative market. It's very hard to get new customers when you're an unknown quantity. And so we started off in South Texas because it has the highest rate of chronic disease of any community in the US, very, very high rates of diabetes and hypertension in particular, as well as congestive heart failure. So we worked with clients who were some of the most challenging clients in the space, quite small and not necessarily familiar with technology. A lot of them had paper-based systems. Over the last few years, we've expanded significantly. We have over 50 clients now in the US. They have practices and skilled nursing facilities and home health agencies in all of the 48 contiguous states in the US. So we've definitely expanded geographically, as well as going from mostly working with small home health agencies to now primarily working with large networks of physician practices or skilled nursing facilities. So we have a much I don't want to imply that our early clients were not sophisticated, because they were extremely passionate and very caring clinicians. But we have more clients at this point who are in the business of healthcare, if you know what I mean by that. So they're better able to scale quickly and to deploy new software solutions, and they have a lot of experience with CMS as well as with private insurers.
Okay. So in terms of so what kind of what kind of run rate are you at right now? Like, and where do you expect to exit?
Yeah. So we've said, I think, publicly that revenue will grow every quarter going forward. We expect that by the end of June we'll be at a run rate of $1.5 million, but by the end of the year we expect to have done around 11 million in revenue and be at a significantly higher run rate than 11 million, so probably closer to 25 million at that point. So this year is really going to be about explosive growth for us. We've spent kind of the pandemic year really preparing for that, and with the contracts that we have now, we've provided projections to the market, and I think with the challenges that the US has faced, which are not as significant as the ones we've had in Canada, but around vaccine distribution and administration, it's likely that won't be till end of June that all frontline healthcare providers and patients over 75 will be vaccinated. But at that point, that really removes kind of the last few obstacles to rapid deployment of our solutions. So the second half of this year is really where we're going to see the most significant growth for this year. The growth we see in the second half of this year is likely to continue on in subsequent years for quite a long time, because as I mentioned, only 3 to 5%, or I think I mentioned, only 3 to 5% of all of the patients who qualify for our services are currently receiving them. And the reason for that is that, the billing codes are relatively new. So it's really only the last 2-3 years that clinicians have started to accept them and look at new ways to practice. Certainly with the pandemic, that has accelerated the adoption and acceptance of virtual care by probably a decade. So while the pandemic year itself was a rough one for us, certainly hit our clients in Florida and South Texas very hard, it did encourage us to diversify geographically to all 48 states, the mainland states, as well as Puerto Rico and Australia, frankly. But that's really going to drive accelerated adoption, and certainly Medicare and Medicaid have not only introduced these carrots of the reimbursement codes, they've also introduced a lot of penalties around not providing these proactive services. So
that's good. People are more motivated by pain than pleasure, right? So that's a good.
Yeah, it's a bit of both, but I mean, there is both now. So particularly on the skilled nursing.
Fear of loss. Doctors are more conservative. I think that fear of loss this is like people don't want liability.
People don't want the liability. People don't want the change in lifestyle associated with losing a relatively significant percentage of your revenues to penalties. And for skilled nursing facilities who operate on very thin margins to begin with, those penalties can be the difference between staying afloat and not. So using our technology not only prevents them from incurring those penalties, but it introduces new sources of revenue for them. And that's hugely important as that sector goes forward trying to recover from COVID, where so many people didn't want to be in a residential care facility where the risk of an outbreak was so high.
So there's a carrot and stick basically for the market to deploy your technology. So you mentioned something interesting. So you expect that you could hit a run rate of 25 million end of year. So in other words, you're expecting the key growth is going to start sometime in the second half, basically.
Yeah, I mean, we're already seeing growth, no question. But I think, the key growth is going to hit in the second half of the year. And it will be very rapid from then on. I think for a minimum of 3 to 5 years, we're going to see this very, very rapid growth. And both the platform and the company's infrastructure over the last year have all really been reinforced and built and around that expectation of significant, very rapid growth.
Okay, so 25 million exiting 21 with potentially 25 million run rate, things are picking up from there. So, really right now you're at this inflection point, which is, what we like here, on this program is we like those companies which right now, they went through, all that pain of development, years, whatever. And now, this is, so in other words, we get the baby without the labor. So this is, so right now this is the point to look at the stock right at that inflection point where revenues are coming in. Here's what's interesting. Okay, so let's talk about the comps in your space.
Sure.
What are the comps like? Because you're in the health tech, but also SaaS. So that's
exactly. Yeah. So typical multiples for companies in our space would be, 10 to 30 times revenue, 20 to 40 times, or even 50 times EBITDA. And so they're very significant multiples, and they tend to be on the higher end of the range if the company is showing active growth and is profitable, which is certainly the position we'll be in by the second half of this year. I think, frankly, we're going to have higher growth than, any other company in this space, organic growth, certainly. So, we are expecting to command those higher multiples. If you look at some of the companies that have been bought in this space, Vivify by United Healthcare, Livongo by Teladoc. Livongo was valued at, I believe, $18.5 billion when they were purchased, at a time when they were still losing money. And they are forecasting margins over the long term of between 10 and 15% EBITDA margins. Our forecasted EBITDA margins by the end of this year, which would only improve going forward, are over 45%. So, we have a very compelling business model when it comes to valuation, looking at comparables in the space. So I think there's a lot of room to grow in terms of the company's current valuation. And I think, that's a big part of why we're looking at, a NASDAQ listing, and in the, relatively near term, or early next year, I think we'll start, moving towards that goal. And certainly there's a premium that companies get when they uplist to the NASDAQ that, makes a lot of sense in terms of capturing shareholder value. But, more to the point, our largest customer base is the US. So while we may be a Canadian company, and we do have offices in the US, in Florida and Texas, that's likely to continue to expand. And the audience for us is really primarily US shareholders, simply because
NASDAQ loves healthcare.
Yeah.
Okay, so Lisa, so basically, if you're exiting 20 now, how much, I forgot, what Livongo, how much were they doing in revenues when they were bought for 18 billion?
So they were still losing money. They were certainly doing well. I could probably look it up. Why don't we come back to that next time we talk?
Okay.
Remember, because I don't want to misspeak on someone else's business.
But basically, the market. The market essentially in your space. When the market sees velocity of revenue growth, then they could pay 30-40x revenues. So it's potential. There is a possibility. I think there is a runway for the stock to be, for the company to have 40x, a $1 billion valuation. Let's call 12 months from now. You tie it back now. You kind of. But so there is a runway for this thing to be a 10-bagger stock from where it is right now. Assuming you start hitting those numbers, we got to see these contract revenues over the coming months. So I think the key thing is going to be to watch the pace, the velocity of those new deals coming in, the revenues. Very interesting. I got a couple. So let me go to some audience questions here. I think you answered a few of them already. But I think one of the questions I had, which here we have an audience question I think is very good, is where's the moat question? The moat. Okay, so here we go. So Ramsey, what kind of moat do you have, from the technology standpoint? And also, please explain cross-selling services that you envisage.
Yeah. So the moat, there's a number of different moats. One is just that we're the most usable solution, and we're one of the only solutions in the world that offers the full suite of products that we have. But the real moat around us, and which I always stress to anyone who's not familiar with the space, is that healthcare is so conservative. So when we started out, we had to work with those smaller, more challenging customers. We collected, over 2 years worth of clinical data, and that's really kind of the price of admission. So you need to have about 2 years of solid clinical data showing that patients do have those improved health outcomes, that we're able to reduce the average rate of hospital admission in this population. About 1 in 5 of these patients will be hospitalized in a year. Normally, with us, that's well, it's roughly 20%. With us, we can reduce that to less than 1%. So it's a dramatic difference in terms of health outcomes and in terms of cost of care. Without, pardon me, so a new entrant to this market would need to get out there and then spend 2 years generating comparable data that shows usability as well as efficacy, safety, issues around claim submission. So we've got a pretty good head start. And the healthcare market is one where people, if you ask your family doctor how he likes his electronic health record, 95% of them will say they hate it more than anything. But in this market, they like to buy based on reference, so they like to use what others are using. We have a first mover advantage in the community healthcare space in that $100 billion market doing what we do. And we do get a lot of our clients now from inbound sales. So customers who've done global searches looking for a platform that meets their needs, who come back to us and say, you're the only thing out there. So it's going to be very difficult to get anybody to switch away from us if something new comes into the market. But no one's really going to be able to even potentially compete until they've generated that 2 years worth of clinical data.
Okay, so here is the number. So Livongo is doing 60 million a quarter.
Yeah.
So so they were bought at a big number. So 240 million. I mean, it's 18. It's a massive number. I think it's more than 40x.
Yeah, I mean, the announcement they had about the deal was an $18.5 billion valuation on Livongo at a time when they were doing about, if we do that math, 240 million in revenue, but were EBITDA negative. So.
Okay. A couple of people asking about exit strategy. Do you see the company being sold to a larger company? CloudMD, which is one of our clients, or or Teladoc. I don't know.
Yeah, I mean, I think, I know that Well and Cloud are moving into the US, but I think there's still a relatively unknown quantity down there. So I think, the more likely potential acquirers for us would be an Amazon or one of the big healthcare payers, like United Healthcare bought VSBY. So, there's lots of other big payers out there, Humana and others. I think those are more likely if we look at the trend to consolidation in this industry. I think in order to acquire a company like ours and continue to make it successful, you have to have a lot of depth and experience with the US market, particularly on the regulatory side, which at the moment, companies like Well and Cloud don't have. Not to say that they're not looking to bring that along. But, Well and Cloud have such a big presence in Canada, and in Canada we have no billing codes for the services that we offer. So, it would be a purely a play that would purely expand on their U.S. business, and I think would probably make more sense for some of the other
players. It would have to be somebody. I mean, basically, look, there is a number of players, like you mentioned, Amazon. There's a bunch of players who, if they can write a check for a couple of $1 billion, it's not a big deal.
Right.
As long as they see like you have traction, just I think the Livongo deal basically kind of paves the road in two ways. One is for potential buyer, but also for institutional investors. I mean, because the institutions in the U.S., they really can't buy your stock just yet. So until it's NASDAQ or whatever. So I think that's why I think there's this opportunity for the retail investors right now. But at some point, they're going to look at that. Once you're NASDAQ, they're going to say, okay, Livongo was bought for X. I mean, that becomes their story. I mean, they can understand that easily. They can understand the upside because of the Livongo deal.
Right. And we have to keep in mind, Livongo, their product serves the type 1 diabetics, and that's 10% of the diabetes market. We address the other 90% plus that 10%, plus all the other chronic diseases. So we have a much broader offering than what Livongo has. And Livongo's EBITDA margins are so much lower, even forecast, than ours will be because it's a very human resource intensive business. So they use a lot of case managers to have kind of very frequent communication and coaching sessions with the type 1 diabetics. And what we have as a pure SaaS model is really much more scalable.
Okay. So we're running a little bit behind, so we're gonna wrap up in a few questions. Let's throw out some tough questions here, which I like this. What happened around 2018 that caused the stock to tank? Because if I look at that chart, you see 2018 it had that.
Yeah, no, 2018 was like the Black Plague year for me. And it was not a fun year. So we had the experience that a lot of companies in our space had where, because it was the first year that Medicare had introduced a billing code for RPM, there was a lot of confusion around who qualified as eligible patients. So we ended up with quite a large percentage of patients that we had already onboarded turned out not to be eligible. So what we've done in the wake of that, we had to write off a big chunk of revenue as bad debt. And what we've done to prevent that kind of thing from ever happening again is we built connectors into all of the state Medicaid databases and the federal Medicare database so that we can pre-screen patients for eligibility and submit pre-authorization forms. So never again will a patient who's not eligible for reimbursement be put on our platform. Other companies in the space just rely on the clients, the healthcare organizations, to do that pre-screening, but once bitten, twice shy, we're not going to make that mistake again. We also had some issues in 2018. We'd acquired a company in 2016 called CareKit Health that was the foundation of our platform. Some of the team that came in either immediately through the acquisition or related through some of the senior people that we brought in through CareKit who hired their own team. Essentially, and this is public knowledge, set out to kind of develop a competing business and steal our source code and our customers. So we had to enter into litigation. That was resolved in our favor. A settlement was paid, but it was a challenging year. I mean, we've certainly been through the fires, and I think that's a benefit of getting involved with the company now. That we've had those experiences. We've put in place not just on the screening side, and we've changed our contracts around when we get paid, and to increase the certainty that we get paid, so that we know the second a patient is onboarded, we will collect that revenue. But beyond that, I've really worked hard to strengthen the company. We originally had the bulk of our personnel in Vancouver. At the end of 2018, I closed that office, moved it to Hamilton, where I live, just outside of Toronto, and rebuilt the team I took it down to 3 people, myself, the chief medical officer, and one of the founders, and rebuilt it back up to, I think we were over 30 people now. And brought in, really strong CFO, and we brought in KPMG as our auditors. So, we have a lot of rigor now around all of the company systems that maybe wasn't there when we were, a young company and just, starting out. And a lot of companies in the States got, kind of caught in the early days of RPM as well. But we're a company that's, really very mature in terms of its infrastructure, and we're right at that point where we're ready to start really demonstrating that shareholder value. And Jack, I'm an engineer by training, and we have been very quiet.
You're a PhD also.
Yeah, in chemical engineering. Yeah.
Dr. Lisa.
Yeah, well, no, Lisa. But, we've been really quiet in the market for the last 2 years because there was uncertainty in the business, and I'm not comfortable getting out in front of the market talking based on anything other than data. And now we're at a point where I'm really comfortable getting back out in front of the market because we know everything's locked down, internally. We're really ready to go and to support this growth. And we have the contracts with these much larger clients, and that we know, the revenue projections are based just on the contracts we already have, not based on the business development that's a constant ongoing activity for the company. So we're really in a position where I think it's a good time to get involved with the company. I think new investors will benefit from the lessons we learned in the rocky years, and investors who stuck with us, I think, will be very pleased that they did.
Yeah, we're gonna 2 questions and then we're gonna wrap up. But I think I want to make a comment here. Is that I think the key thing is, a lot of retail investors, I think, hey, you buy microcap and go straight to the moon, one-way ticket. The reality is, essentially, we're in the public venture capital business, right? So these are startup companies. Everybody hits a road bump. I mean, every company hits a road bump. So the time to get in is after they went through all that. After, so again, we want the baby. We don't want the labor, the pregnancy. We just want the so now is the inflection point. Lisa, I want to ask you mentioned your engineering background. So just tell us a little bit about your background and team.
Okay, I'll do that very quickly. My background, my first degree was in life sciences. My next degree was chemical engineering, another undergrad, and then a PhD in chemical engineering focused on manufacturing drugs using mammalian cells or animal cells. I moved to Boston once I was finished my postdoc, and worked at a biopharmaceutical company that went public in the summer of 2000, started the day at $15 a share, closed the day at 45. So very successful IPO. I was part of the dog and pony show for that IPO, so that was my first exposure, particularly to the US capital markets. And then this is the fourth company that I've run as CEO. I've sold my previous privately held companies. The first one was sold to Millipore. The second one was sold, the third one most recently, VitalHub was sold to the guys who just exited MedWorks, and they've since taken it public. And this is the first company I've run in Canada on the public markets, but I've been here for 5 years, and I think we have a lot of strengths going for us. When I brought in the new team, we have now extremely solid depth on the technical side with our chief product officer, our chief technology officer, our chief innovation officer, and has a lot of experience in the tech space and comes out of a very famous academic institute in Toronto, the Institute for Biomaterials, and I think it's bioengineering. So we have a really solid team in terms of both the current technology and looking forward to the next generation. And then we've focused very much on building a really strong team in the US for business development. So very senior people who have a lot of experience working in the space and are very well connected at the C-suite level to a lot of big healthcare clients. So I think we have a really solid team that can absolutely grow this to $1 billion business and beyond.
Okay. Key point there, $1 billion business and beyond. So on that note, what's your vision for Relic 2-3 years out? Yeah, 2-3 years, by the way, is way beyond the time spent. Our audience wants 2-3 weeks, but the reality is 2-3 years out, what is Relic going to look like, assuming things go more or less on track?
Yeah, I mean, I think Relic will be, without question, the market leader and have dominant market share in the virtual care remote monitoring space 2 to 3 years out. We will have a very large customer base in the US primarily, but hopefully Canada will have come around a bit by then, and there'll be opportunities for us here. We are getting traction in Australia as well, and I expect us to continue, global expansion in 2022 and 2023. Certainly for the near future, the US is our primary focus, but I expect us to be the market leader in this space within the next 2 to 3 years. And I expect that this year alone is going to be a really significant growth year for us. So while we can't, ever guarantee in healthcare that, you're looking at a more conventional kind of pot stock, let's say, or Bitcoin, there certainly are and have been very significant valuations in this space recently. And so I think there's a lot of opportunity long term, but also a lot of opportunity short term. Okay.
We're going to wrap up. Upcoming milestones. What do you have coming up the next, let's call it 6 to, next 30 to 90 days? What are the key milestones that investors should keep an eye on?
Yeah, I mean, definitely in the next quarter, we'll be hitting profitability. That'll be a really key milestone for us.
Profitability.
Next quarter profitability. And then I think beyond that, investors will be able to see that month over month, we have increasing revenues for the foreseeable future. Certainly over the next, year, 2 years, 3 years, there'll be significant revenue increases every month. And also watch for the new contracts. We certainly aren't letting up on our business development efforts.
Okay. Lisa, last question. This is our favorite question that we ask at the end of every interview. In top 3 reasons why investors should consider Relic right now.
I think this is a key year for us. This is really going to be our breakout year. We're kind of at an inflection point or just before an inflection point, and one of the key milestones around that is hitting profitability. But we're going to see very rapid growth this year, so this is a really good time to get involved with the company, because I think we're still at a very early stage, but we'll be a very different company by the end of this year. I think in terms of number 2, our second reason, over the last 2 to 3 years, Medicare and Medicaid have gone from having one reimbursement code that was valued very low in terms of the amount of money that our clients could generate in revenue using it, to now over a dozen reimbursement codes and a significantly higher level of reimbursement that allows physician practices to generate between $500,000 and $1 million in new revenue. So there's a lot of new market pull for us in the space. And then I think, there's, as I said, I think at some point during this conversation, only 3 to 5% of the patients who are actually eligible for these services are currently receiving these services. So there's a huge amount of room for growth in this sector, and with the combination of those reimbursement changes and also just more understanding of the value of virtual care as a result of the pandemic, I think that market is really poised for explosive growth. So it's a good time to get started in this sector.
Lisa, this is, my comment is kind of from a technical perspective, or maybe like a old Wall Street superstition, is that, stocks tend to go back to their old highs, because if they did it once before, there's a good chance they could do it again. So, that's one of those things. Okay, Lisa, on that note, I want to thank you. We're going to catch up with you, probably the next week or two, and we look forward to hearing more good news.
Great. Thanks so much for having me.
Thank you.
Thanks.
Okay. Okay, let's get ready for our next presenter, our next speaker, I should say. It's an interview. So here we go. Visibly. Okay, stand by. Okay, and is Jay there? There he is, the man, the legend. Jay, welcome back.
Good morning, Jack.
All right, Jay, can you just tilt? I want to get the camera tilted a little bit. What, you wearing a tie today? What's going on? What's going on?
I knew you would be.
Must be a big day. Something must be happening here. Must be some big. Must have big. We're gonna find out. We got a lot of people waiting for you in the audience here. So without further ado, let me do the quick intro for the recorded version. Welcome everybody to Wall Street Reporter's next Superstock live stream, February 16th, 2021. We are back with Visibly Group of VSBY, CSE, VSBGF over the counter. Stock has been moving up. Let's find out if this is going to be, our second 10 bagger of 2021. Jay, is this going to be the second 10 bagger? We're getting close. We're getting close. Started at 17 cents, 80 cents right now. You got to get to $1.70. So halfway there.
We've only just begun.
I like that. I like that. This is what we got to find out. So a lot of, I've noticed a lot of the pace of news partnerships has really been accelerating since December. Like end of November, December. Today, I want to kind of get into an update, all the new partnerships, the new deals. I want to unpack that because we do have, again, a lot of people right now, new people on the live stream. Just give them a quick snapshot. What does Visibly do, the markets you're in?
Sure. Visibly is a computer vision company. We apply computer vision, which, if you understand what that technology is, we teach computers coupled with cameras to understand and contextualize and report on the things that they see. We do this in retail and we do this in security. In retail, we're measuring movement of persons within retail for operational efficiency, what they call in our world the shopper journey. We also measure movement of persons within retail, particularly with respect to their engagement with brand. That's a big wallet in retail. When brands can measure people's engagement with them by way of digital display and computer vision, we can find a way to monetize the brand engagement at retail. And that's an explosive market. Had been incubating for 3 or 4 years, testing some theories and some engagement modalities and of course some business models. And we're now past that testing phase and we're in deployment. Our biggest deal in the company's history, which I'm sure we'll talk about, is monetizing the store as an advertising medium. The second half of the technology that we address is computer vision for the applications within security. You can imagine if you're in the security environment, the Achilles heel of security, when I put up CCTV cameras, is the number of people that view those camera feeds. We're human beings, we're finite in nature. And there's example after example after example of incidents occurring within CCTV monitored areas that operators didn't see. So the hypothesis of artificial intelligence and computer vision in the security world is we take multiple video streams and we analyze for anomalies. Anomalies might be as simple as finding a person that is banned from a facility, a trespasser. It could be a weapon. It could be a fire. It could be a car accident. It could be multiple smart city utilities. The garbage cans are full. All the cars are on the alternative side. If you're an ex-New Yorker like you, Jack, you know that you've got to behave yourself with respect to your parking restrictions. These are all computer vision challenges that we're now adopting because the cost of doing so has come down to a point where there's an economic value to it.
So, and I think also in the anybody, if they want to see like the demos, all that stuff, we have like multiple videos that you can check on our channel with Visibly. We actually, you got to see the whole video, which really explains the potential uses for market. Really, you're addressing, multi-billion-dollar markets. I mean, between the security side, which is one aspect, and also the retail, the kind of store as media, which is really also taking off in Latin America. You combine the two of them. The store as media and the security aspect.
Yes.
So, some incredible things happening here. Let's get into the recent news. This is what I want to kind of like unpack the last couple of deals, what they mean for the company. So let's start off with today. What is this?
Okay.
What does this mean?
Today we signed a contract with Eos Lynx. Eos Lynx is owned by Renewable Energy Alternatives. You can imagine that if you're in the solar farm business in the US, you have to be an expert at subsidies, how to tap into the federal subsidies and make that economic model work for when you're deploying solar farms, any alternative energy, frankly. And so that company, REA, Renewable Energy Alternatives, spawned another company called Eos Lynx. They're in different segments of the similar marketplace. Eos Lynx value proposition is electric vehicle charging is exploding. In fact, you'll hear people comment that the problem with adoption of electric vehicles has everything to do with the reach of the distribution of EV charging. Wouldn't it be, I don't own a Tesla, but if I did, if every time I went to charge my Tesla, I had to wait for 30 minutes, this would be a significant difficulty for me in terms of adoption. So that's a problem in the US principally right now because the distribution network is still maturing. The hypothesis of Eos Lynx is deploying solar-based EV charging stations across a broad grid, many thousands of locations, and delivering security and digital display on top of that platform. If I'm going to wait for 15 minutes while I charge my Tesla, not only am I a desirable audience, a high disposable income, etc., but I'm captive. I'm going to be receiving messages from a digital display, which are monetizable from an advertising perspective. I'm solar connected, and I've got a security apparatus in place. So that's the hypothesis of Eos Lynx. The hypothesis on the other side, Renewable Energy Alternatives, is these solar farms are in the middle of nowhere. What a great application for computer vision, proactive security, so that if something occurs where nothing should be occurring, we can identify, alert, and preempt. And that's the idea. So on both of those marketplaces, we're providing computer vision solutions. On the Eos Lynx mobile solar trailer side, that's both digital display and security, and on the solar farm side, it's security. So we're delighted by that, by the opportunity to do business with these guys.
Okay, and so Jack Topolowski is asking, so there are 1,500 locations that you can scale to?
Well, they've told us, and it was in the press release, that there will be at 1,500 locations by the end of 22 and 5,000 by the end of year 3. So the unit level economics are important to understand. So what I'm going to do is I'm going to break it down in 1,000 unit blocks, if you can think of it that way. 1,000 locations, and we announced in the press release the first deployment on the solar farms with Puerto Rico, where there's 20 cameras. So if you can assume that each location is 20 cameras and 1,000 locations, we're not always the same, but depending upon the metrics we run, we're between $25 and $50 per location per camera. So per camera per location. Sorry, per camera per month. So that's 300,000. If it's 1,000 locations, 20 cameras, that's 30,000. That's 20,000 cameras at $25 a month. This is a significant addressable market. Just for Eos alone, that's $600,000 annual rate of return, just based upon their first year projections.
No, so I got wait, so it's about 500 grand a month roughly revenues.
Yeah. Well, at full scale, yes. Yeah.
Okay. So the deal's worth $6 million a year, and again, I think we should add these deals keep adding up. This is like just the Modelo. There's multiple deals that you're doing, which are each 5 million, 10 million potential. They're stacking up. I think one key thing is this is so it's recurring revenues. You're in the SaaS business. You're not in the hardware business, right?
We're not.
Okay.
We're not in the hardware business. Yeah.
SaaS, software business, recurring revenues, high margin. What's now? You got a couple of other deals. You got this. What was it? 9/11 Inform. You got
that's that 9/11 Inform is I call it a sleeper. It's a really interesting deal, and it's important, I think, to talk about how we identified them. The schools marketplace has always been attractive to us. It's a marketplace that's got a well understood funding mechanism. There's federal cash available to deploy security infrastructure in schools. And the big players, there's 4 or 5 big players. We targeted 911 Inform. We understood their value proposition, and we beat competitors to win that business. And if you think about what they do, it's really interesting. There are 2 laws around 911 location. If you might not know this, but your mobile phone pings and tells people where it is all the time, and that information, in the event that a 911 call is made, is provided to the 911 center. Well, there's 2 laws, Kerry's Law and Raybaum's Law, both of which came into effect this year, which require infrastructure investment to make that location data more granular. So if you're in a school, one of the problems with 911 is you can't tell the difference between the 3rd floor and the 1st floor, because it's an X and Y axis. It's not a depth axis. So what 911 Inform does is it provides building mapping systems, and the 911 data, location data, is provided to those building mapping systems. So if Jack calls from the gymnasium, we can tell you're in the gymnasium as opposed to 3 floors above the gymnasium. And we overlay video cameras. So a first responder arrives on scene, think of a SWAT team. He opens up a mobile app, he downloads the building coordinates, and in real time, he can pull the 911 data and the video data of actually what's happening in the school. What's inspiring to me about that deal is it will clearly save lives. It will identify what they call in the first responder community, provide situational awareness, what's happening per room with a video overlay on top of 911 location data. So it's really interesting to us. We're excited to start our first pilots in New Jersey in the next 30 days.
No, so this really, I noticed the pace of deals is starting to build. We got one of the big ones I think is the Modelo deal. A lot of people are interested in that. If you can kind of recap what that's about, people want to know, and give us an update.
Sure. Well, first the update, and then I'll break down what we're actually delivering. It's a complex deal. There's lots of moving parts. There's a gaggle of lawyers involved. It's the most complex deal that we've done as an organization. In my career, it's probably top 5 most complex deals, but it's moving forward. We're incredibly inspired by the commitment these guys have to the project. Their faith in us is outstanding. There's no wavering. We're moving forward. We expect it to be done shortly, but it's a complex deal. So in terms of what we're delivering, Modelorama is a conglomeration of retail locations in Mexico. AB InBev, the parent of Modelorama, has both direct and indirect influence over between 100 and 120,000 bodega level stores in Central and South America. The objective of this network is to build the world's most comprehensive digital network across all those platforms, delivering three things. One, digital display, monetizing Pepsi at a small store, or monetizing, more accurately, Budweiser, delivering Budweiser impressions, advertising at the store. We measure that with our computer vision for advertising efficacy. We measure number of men, number of women, engagement, sentiment, age, all of that delivered as a comprehensive data set for the advertiser as a way to support the advertising. The third piece is the security piece. If you run a small 20 square meter convenience level store in Mexico, you're facing threats to your security all the time, every moment of the day. So we deploy digital display, data collection and measurement for advertising support, and security for the purposes of security. All that delivered under a single umbrella. The objective is that we've talked about publicly is 50,000 stores, but the overall addressable market is north of 100,000 stores.
And how much is it worth, dollar-wise, per store, per month?
Well, we're still finalizing the economic model, but from Visibility's point of view, there's two revenue streams that are beginning to articulate themselves. Well, have articulated themselves. The first is the revenue stream associated with the licensing, which we get between $10 and $20 a month because of the massive volume of this deal. We broke our regular metrics, and we negotiated a deal with them between $10 and $20 per month. The second revenue stream, so that revenue, the first revenue stream in 4 years is in the neighborhood of $30 to $40 million.
How much again?
$30 to $40 million in the first 4 years.
Okay.
Just based upon projections, Jack. Just based upon the pace of growth.
Okay.
The second revenue line is from the media. Because we're playing this comprehensive role, we're not restricting our deliveries to just the software piece, because we're pretty comprehensive media company as well. We have brand relationships we're bringing to the table. So we're part of a combined structure, which has not yet been defined, but think of joint venture or combined company, where we own 33% of the revenue that comes from the media sales. Well, that's $400 or $500 million over the same 5-year time span. So we're still finalizing all those details. All that data will be disclosed when we're final. But for us, it's an enormous opportunity. Not only is the largest digital network being built today in the world, it's significantly bigger than the second player, if you know what I mean. It's got two discrete revenue lines, and it's with one of the most iconic brands in the world. So we really couldn't be happier with that deal.
Yeah. So basically, if anybody is like kind of tracking these numbers, right now you're kind of the new deals right now, you're going to be up to roughly, by the time you exit 21, could you be at a run rate of, what would be the run rate? It could be north of 20 million a year at this point.
15 to 20 million is what we're targeting right now.
Okay. And that's
I would be happy to report greater than that, but we're going to hold the line at 15 to 20 for right now, because the issue when projecting that is you're projecting pace of deployment.
Yeah.
And right now we're active and we're deployed in 4 countries in the middle of freaking COVID. So we're just going to be conservative on our estimates. We have to make sure we meet those, because if we don't meet them, we're going to have a lot of questions to answer, and we don't want that. We want to deliver. So our current objective and target is 15 to 20 million in bookings by the end of 21, and we think we'll make that with some despair.
Okay. So basically, the key thing is we really don't know how the pace of it is going to work, because there's factors that are out of your control, COVID or different things in the market.
But from an ABI perspective, Jack, it's important that we can't go fast enough. So the objective for the first quarter is 2,000 locations. The objective for the first year is 5,000 locations. So there's nobody that's tapping the brakes or getting anywhere close to the brakes, despite other macroeconomic issues that might be impacting retail. It's not impacting this part of retail.
You're going to have 2,000. You're going to be in 2,000 locations in this quarter, first quarter here.
By the end of this quarter, yes, it'll be our run rate. Yeah.
Okay, that's going to be a significant number. Okay, so things are really picking up. I mean, there's
the entire organization is focused on execution at the moment. This separates the men from the boys. Because it's one thing to go land a deal and talk about the transcendent and crystallizing expectations of that deal. It's quite another to get it deployed with the revenue in the rearview mirror. And that's our principal focus in Q1, execution.
So we got a comment / question. So potentially 50 million based on these two deals, the Modelo Rum and this. So is that about right?
I think that's about right. Yeah, I'll have to go back and look at the numbers, but that seems right. Yeah.
Okay. So how big is the total opportunity? I mean, so I think what's the takeaway here is just in the last couple of months, you've signed a couple of very substantial deals. But are you just scratching the surface, or is this the whole? I mean, like, how big is the total market opportunity that you're going after? I mean, like with between the retail, between the U.S., like. I mean, what is the upside potential here?
Well, we haven't talked too much about this, Jack, at least not in this conversation. But on the security side, the current security services market in the U.S. is about 100 billion. I'm just restricting my comments to the U.S. just for easy math. 100 billion is the U.S. size. It's going, based upon estimates by Forrester and others, to between 190 and 200 billion by 2023. That's only 2 years away. That growth is AI investment. And let me break that down for you. No one's going to install dumb cameras anymore. I'm not saying nobody, but the bulk of the growth will be in artificial intelligence infrastructure, because the artificial intelligence is the very next thing for security. Obviously, we moved from a place where security is all about retrospective or investigative or forensic. What happened when something went down, to a place where what's happening as it's going down. Now we're moving away from forensic to prevention. Prevention necessarily means monitoring. We know we can't do that with people. The math doesn't work. So we're doing it with AI. And so the growth, that 100 to 187 to 190 billion growth, will be principally in AI. So all of that sits in front of us in just the next 24 months. That's just the US. Obviously, that's replicated country over country, region over region, which actually, Jack, if you don't mind, leads me into perhaps the most significant press release we've done in the last 2 weeks, which was a press release we did with Ability Corp out of Taiwan and Intel. And this is a result of 9 months of development work, starting with the hypothesis of, guys, today when you deploy an artificial intelligence smart camera, it needs a computer, it needs a camera. The computer pulls the video stream from the camera and creates inference logic, decisioning, what's going on. That's where the algorithms run on the computer. That's an expensive proposition. Cameras are sitting in the $600 to $800 range for decent resolution, and computers are in the $500 to $700 range. The hypothesis of Intel was, we want you to run your inference logic visibility on the camera itself, a little chip on the camera that runs the inference logic. That's a $300 camera, inclusive of chip. So if we're able to do that, we would break the economic model. We'd open up a mammoth marketplace, and that's precisely what we did. So when you see us doing these announcements, 911 Inform, Eos Lynx, more coming in Latin America, it's because we've broken the back of the economic model, and places that were previously unaddressable are now not only addressable, Jack, but scalable. And that's, I think, what's critical to us. That's why I refer to that deal as kind of not fully appreciated yet. The appreciation of that deal will come as we start to land deals connected to that innovation.
Okay. Question from Farron on one of your newest deals, which is the Westrock. Again, if you can just give a quick recap.
Sure.
And what's the update?
So who is Westrock? Westrock is the largest packaging company on the planet. We've all seen their stuff. They're an S&P component company, large organization. I think this goes back to Jack, that something we talked about before. We align with force multipliers. We don't necessarily align with companies that are small or big players in the category. We either align with enormous disruptors like 911 Inform, huge disruptor. They won the Frost & Sullivan Safety Innovation Award for 2020. That's a disruptor. Westrock is a market mover. Westrock's historical business is display advertising. They build physical displays for retail. It's a huge business, the largest player in the world. That business is pivoting to digital en masse. So the reason why they did the deal is they recognized that their business was moving that way. We're a major player. We have enormous integration. I have one member on my executive management team that basically performs a role on their executive management team. So we're tied at the hip and we go almost everywhere together. We've got multiple deployments already in retail, and we'll have 3 more announced probably this quarter, and more coming with major brands. So we're really beginning to do that with them.
And this is the technology where your AI, basically you have in the store, you have a digital sign near like a key product area, and based on who's passing by, it can give them a customized message.
It can give them a customized message, and if that's too creepy, because for some retailers they don't want to do that, we're measuring footfall, we're measuring men, women, all that data collected supports the spend. That's why advertisers spend the money, so they can get analysis and depth of analysis on traffic. It's basically what created Google, Jack. We know what created Google, and that's the ability to understand and measure impressions on the internet. We're measuring and understanding impressions delivered in bricks and mortar. That's what Visibly does on the retail side.
Yeah, it's a massive opportunity. Okay, so
oh, yeah.
And also I should mention. So you mentioned the force multiplier thing. So again, your partnerships are like with Westrock, which is massive in the store space. You also with Sensormatic, which is in store. So you have I guess your foot in the door with potentially covering just about everybody in the retail space between those two players.
We bring to them agility, innovation, and speed, and they bring to us distribution and reach. It's a good marriage. We can't possibly get to the places that they're already. Sensormatic is an example. 185,000 discrete customers in 104 countries. I couldn't build a sales force fast enough to reach that many customers. They're there already, and they view us to be a very strategic part of their business, and look for that relationship to get tighter as we move into the next quarter.
One thing we should just touch on, because this is, I think, which is important, is you're getting a lot of data. You're collecting all this data between the security side, between the retail side. We talk about monetizing the data. Because this ultimately that could be the real. That's like the big upside there. What? So Ray J is asking, how will you monetize all this data?
Well, in the U.S., I should point out really quickly that one of the things that ABI saw in us is precisely that, which actually speaks to their level of understanding of the direction the marketplace is going. Can you imagine having at scale, understanding customer movements and transaction level data on 50,000 stores, just to pick a number in the middle of the range, per moment, per day, by sex, by hour, by sentiment, all of that tracked against transaction data. Incredible data, unlike anything in the world. So part of that relationship is when we go into this combined group together, we're co-monetizing that data. ABI has 630 unique brands. Each of those brands live and die on the data. So to us, it's a great way to test that hypothesis. So who monetizes that data? We monetize that data together with ABI in this construct. And as we move that idea to the US, as we deploy into retail, we own the data exclusively with nobody else. And so far, although it comes up every time we have a contract negotiation, we successfully have made the case every time so far that we own the data. We don't co-own the data, it is exclusively ours. Now that data has a certain value when it's a small data set, which is what it is now, and becomes incredibly valuable when it's a larger data set, which is where it's going.
Question: which will be bigger, retail or security?
I get that question a lot, and it's, what is Modelorama? Is that a retail deal or a security deal? Because it has both. I think it's too early to say. I can tell you that with some of the partnerships that we've not yet announced in the security space, there's a couple of players with enormous horsepower, and if they dig in the way I expect and hope they dig in, the answer is easy security. But we'll see, and we're continuing to invest in both sides. Thankfully, it's the same plumbing, Jack. Right, it's the same engine, so we really don't have to make a bet that would constrain or direct R&D, if you know what I mean. That's important.
You have a lot of leverage based on your existing technology. So this is, this is like, good margins, a lot of leverage. Val is asking, are you getting traction in Asia or Europe?
No and yes. Asia we haven't invested in at the moment, and we're just looking for the right opportunity. Having said that, we have two channels, UST Global, one of them, who are heavily invested in Asia, that are dragging us into two opportunities in Asia, one in Singapore and one in Hong Kong at the moment. So we'll see if those manifest. But again, this is back to the hypothesis. Our go-to-market model isn't us investing directly in Asia. It's us investing in our partners who invest in Asia, as an example. And that's how we open up those marketplaces. In Europe, in fact, this morning we were on a call about a deployment in Italy that will probably happen in the second quarter with very large grocery retail. So we're starting to get European traction right now.
Okay. Are you expecting more deals this quarter?
I'm always expecting deals. We're trying to keep up the cadence of the deals. We want to make sure that we're communicating to the marketplace exactly what we're doing in as granular a fashion as we can. But yes, we expect more deals, both on the retail side and the security side.
What point do you expect to achieve profitability?
Our current models, based upon a $15 to $20 million fiscal 2021, will show us profitable round about the turn from the third quarter to the fourth quarter, in that neighborhood. This year.
So this year, okay. The next 9 months.
Right.
Okay, let's see. What other questions do we have here? Hang on, Jay, stand by. We get a lot of questions. I guess here's a fair question. What can go wrong with any of these deals that could derail? These I think the numbers you have are conservative, right? That 15 million plus this year.
I believe so. Yes. Yeah.
What could go wrong? Give us a laundry list.
Well, listen, we've successfully navigated COVID as an organization, and it seems to me like dealing with that it kind of makes you bulletproof to anything else. But I suppose if someone were to pressure me, what could go wrong? Poor execution. But as an operator, I'm an operator, and I focus on execution. So we've added a little bit to our staff just because the risk of suboptimal execution is just too high. So our focus right now is not on necessarily bringing new fish into the boat, although we're really never stop doing that. It's making sure that those we've landed, we execute properly, and that's a very strong focus of the company. We spend a good deal of our time strategizing and dealing with those issues, execution issues.
Okay, we got a question about was just recently announced, the Canadian Tire stores. Zubair is asking, are you expecting to get into more of their stores? How many do they have? How many are you in?
We're not disclosing the number, but I can tell you that it is no longer one, which is where we started. It is now growing. And we agreed that we wouldn't talk publicly about it until it was ready, but we're growing that footprint right now, both with respect to capacity management, is this computer vision driven occupancy, and loss prevention facial recognition. So we're really excited about that. And there'll be further announcements on that.
Can we expect a partnership with TELUS ADT?
There's a component of our strategy which has not yet been disclosed. I mentioned earlier a major horsepower player that's going to assist us in that marketplace that is focused on carriers like TELUS, carriers being AT&T, Verizon, etc. And so yes, they're part of our strategy, probably mid Q2.
A bunch of people asking the privacy question, because this always comes up. You want to address that? I mean, you could, I guess, turn up or turn down the privacy for different markets?
There's always privacy concerns. And generally speaking, this can be a 4-hour conversation, but I'll make it really short because it always comes up every time. We don't collect personal data. We just collect anonymized data. So we don't collect Jack Marks as Jack Marks. We collect a man of a certain age with a certain sentiment, movement within store geospatially in a certain fashion. So nothing we collect, store, or manage can be deconstructed or reverse engineered into identity. Because of that, that gives us a pretty clear path into areas that don't bump up against the most aggressive privacy legislation like GDPR, which is in Europe, CCPA, which is in California. All with 2 exceptions. In both Illinois and in Texas in the US, the mere fact that you can collect demographic data, age, gender, sentiment, that's illegal without consent. So we don't do it there. We just avoid deployments there. In every other state, a more practical approach to privacy has been taken, where we are completely out of the crosshairs of the privacy concerns because we don't collect any personally identifiable information.
Okay, we've got a couple of accounting type questions here. What are expected R&D expenses moving forward?
We run on the neighborhood of $1.5 to $2 million of R&D. That's our projection for 21, and it was not a whole lot different than that in 20. So I don't imagine it's going to change a whole lot. I can tell you though that there are some conversations going on with key partners that wish to underwrite our R&D because we're faster, better, more equipped, and that's a scenario we would certainly entertain.
Kobe's asking, when will you see improvements in the operational margins? All this revenue growth is great, but it works against when we have negative margins. So what's
the good news about us is that we're software as a service, and we run at margins that are north of 85–90%. There are some instances, I'll grant, that we get tricked into or forced into supplying hardware, which blends our margins down to 50–55. But in terms of an EBITDA, we'll be going forward as we normalize our operations, as we look to go profitable and the end of this year, we'll be on a normalized basis, we'll be in the 40–45% EBITDA range.
Sam is asking, since you have Canadian Tire, can we see Walmart, Costco, what are the I guess he's asking, what other big brands can we see in the US?
We have multiple conversations going on in multiple retail categories. The greatest attraction is in the grocery category, but there's multiple engagements in what we call the DIY category right now. And Canadian Tire doesn't easily fit into that category, but it'd probably be the closest to that. The US equivalent to that might be a Lowe's or a Home Depot. So we're seeing traction in that category. As you might know, Jack, retail hasn't been universally strong in 2020. Mass, if you're in Nordstrom's or Macy's, life's miserable. You're down year over year. But if you're in grocery, DIY, even drug, you're up year over year. So that just correlates to where the investments are occurring, not surprisingly.
Question, can we expect deals in India, security deals in India?
So one of the partners that we have for Mexico is an India-based integrator, one of the largest in the world. And their desires are to take us into India. Early days, commercially not solid yet, but that is absolutely a desired location because of the demand. There's significant demand of security solutions in that marketplace.
Question is, do you have enough staff to execute this here? And
we actually just went through a mini boom. Sorry, Jack, I spoke over you. Say that again.
I guess he's asking, do you have enough staff, and are you hiring? Which departments? I guess he's a recruiter, maybe he's trying.
Well, I was just saying we went through kind of a mini boom, hiring maybe 6 people in the last 60 days. All of them focused on execution, as I mentioned earlier. So project management, process management, installers, remote support, that sort of thing is where we've been spending a little bit of additional money. Again, my focus is not necessarily on dealing with the demand. The demand is there. No problem with the demand. It's making sure that we satisfy the demand and execute perfectly. And that's where the focus is.
Okay. There was a question. I can't seem to, there was, I guess, a question or a comment. I can't see. We got a bunch of, I missed, but I guess it was a comment about the FANG stocks. Would Visibly be of interest to like a Google, Facebook, or any of these players who, again, they're in the marketing technology space? I mean, you're kind of touching on a lot of the areas that they want to get into because you're touching the bricks and mortars. So this is like the last, you're the last kind of frontier for this. Is the last
of the FANG,
Amazon, excuse me.
Of the FANG stocks, there's only 2 that really understand this inflection, in my opinion. The others probably peripherally understand it, but 2 have got strategic initiatives in this category. One is Google. Google has Sidewalk, and Sidewalk is the out-of-home division. So Sidewalk understands what it is to generate advertising impressions and advertising value in non-traditional spaces. Think of out-of-home. Out-of-home could be a bus shelter, could be a billboard, it could be a store shelf. So Google understands that category, and yes, it's plausible that Google will at one point wake up to the possibility that there's a couple of companies here that are making some inroads. No doubt about it. It's not happening now, but it could happen. The other one in that space that is conscious of this category is Amazon. We all know about Amazon Go, or maybe we don't all know about Amazon Go. Amazon Go is the whole reimagining the store so that it's not attended. It uses computer vision and frictionless checkout in your mobile phone to gather up product into your basket and then leave, because the basket is artificial intelligence enabled and we know what's in the basket. You're already a known person. You've got some sort of payment relationship with the supplier, and that's how it works. So the whole frictionless store is an Amazon innovation. We're involved in that as an OEM, a software provider underneath other solutions. So yeah, it's possible that Amazon would view that to be a collaborative opportunity there as well.
You know what's interesting? So essentially, the so-called, I guess you call it the frictionless store. Really, it's basically the store without, people, right? I mean, this is becoming reality. I think it's actually in China. They've gotten some track. I mean, it's not Amazon. It's like there's a decent number of places where you do that. I guess they have it because you pick up the basket and then I think it goes through your phone. The phone's the WeChat, whatever.
The basket is product aware. It's got weight sensors, and so it correlates the basket contents with computer vision and creates a checkout based upon that information.
And China's ahead of us by like a couple of years now at this point. So essentially, is Visibly really going to be a pure play on this frictionless store, or like totally self-service store? Because it has to be a reality. Minimum wage is going up. I mean, every store you go into, more and more, it's a self-checkout. They don't have any cash. I mean,
yeah, Jack, we're a component play. So it's pure in that it's not sullied by other components that lower the margins. So it's still a pure play, but we're a component play. And the really rough analogy I give is we build a catalytic converter that goes inside other product solutions. So this is not yet out in the marketplace, but soon we'll be announcing relationships where we're embedded in frictionless checkout deployments. Our technology is embedded, and that's really exciting to us because it would be tragic if that marketplace exploded the way I'm certain it will, and we had no play there. So we have this opportunity to build our product into other. That's Visibly as an OEM, as basically a component supplier in other people's solutions, which has always been part of our mission and direction, but now we're beginning to make it tangible.
Okay, so this is going to be, I think we're going to see an explosion, this frictionless store thing in the next, I mean, it's going to be huge, but in the next, months, year, it's taking off. So basically, you're like the old ad was it Intel inside, for computers. So now it's going to be Visibly inside for for retail. I mean, everybody's going to have to do this at some point.
Yep, I can live with that analogy.
So yeah, so basically, it's interesting. More and more, you're becoming an attractive acquisition for anybody. It could be an Amazon, a Google, a Sensormatic. I mean, the list is growing essentially for the store of the future. Essentially,
I think we're currently characterized as really promising disruptive technology with a team that seems to be able to put some rubber on the road. The deal with Grupo Modelo, ABI in Latin America, really changed the language of the partnership discourse, because it's the largest digital network in the world. It has multiple moving parts. It has multiple SaaS streams, from 3 modules that we deploy, and it's legit. We're a legitimate player in this deployment because we've been validated by one of the world's most iconic brands, a sophisticated, forward-looking, guys with vision, and that puts us in some levels of conversations, which really reinforces the disruptive nature of our company. We haven't yet, I think, delivered on the revenue projections that we can do, because we're right there as the marketplace is growing. We're growing at that pace, or maybe slightly ahead of that pace. So I think we're getting that kind of credibility, and it's really going to have an impact for the organization and open up strategic doors for us that were previously not open to us.
So Jay, let's wrap up. So why are you wearing a tie today? It was a big meeting? What's going on?
I have a couple of big ones, yeah.
Because it's interesting. Nobody wears ties anymore. I think I'm the only guy, but we do. The CEOs that we've had on the program who've worn ties, their stocks have gone up. Cytodyn went up 20.
The tie index.
The tie indicator. So Cytodyn went up 20x. ESE is up almost 8x. I mean, but so it's
I didn't do that for that reason, but great. Yeah.
Okay, so let's wrap up. So I think we're going to probably be seeing more of you in the coming weeks. It looks like the cadence, the pace, things are picking up for more deals. What else can we be looking at in terms of milestones coming up next month or so? What's on the?
We think we've got a couple of bricks in the wall on the retail side that we're going to start talking about, hopefully by the name of brand and maybe some new partnerships that might enhance our momentum in that category. Of course, the marketplace is waiting for me to get a definitive on the ground with ABI. I perceive there to be zero risk in that deal. It's just doing the necessary blocking and tackling to make sure you've got a contract you can live with for 7 years. So that's underway now, and I think if you look at the sort of the next 3 or 4 weeks, that's probably the 2 highlights that we'll be talking to the marketplace about.
Okay, let's see here. Last question, favorite, which we always ask you, but based on the new developments, based on all the new developments, what would you say is the top 3 reasons, in your opinion, for investors to consider Visibly right now?
I think our market cap right now doesn't fully factor in the ABI deal because we haven't disclosed enough about it for the market to factor it in. But once we do, we think we're going to go for a bit of a refactor. It's an enormous deal, and that'll be clear as the dust settles. That's number 1. Number 2, we're broadening our market reach to include a distribution into things like critical infrastructure, which is the solar field opportunity, and look for us to do more in that category. And just a quick reminder that we have this force multiplier effect with respect to our go-to-market. Major partners that are mammoth or disruptive, sometimes both. And we think that those are the 3 things that make us different and very investable at the moment.
Jay, on that note, I want to thank you. Thank you, everybody, for joining our live stream today. We'll hope to see you again soon, very soon, with some more good news, big news.
Thank you, Jack.
Thank you, and thank you, everybody.